Hey everyone, welcome to the KE Report in a daily editorial. Monday, April 28th, we are chatting with Craig Hemke, founder and editor of TF Metals Report. Now, Craig, look at gold market as we always talk about. It's been choppy over the last week and man, big dollar moves day after day. $50 almost minimum moves up and down, but really just holding right around that $3,300 level for gold gives us a chance to check in on the commitment of traders reports. Now, they are always done as of Tuesday and then released on Friday. We check in with you to see what some of the movements are in terms of commercial traders versus the funds and speculators, long, short, as well as open interest. So, Greg, what stands out to you? Well, what are you seeing in these commitment of traders reports recently?
Well, hi guys. Yeah, it's really interesting. I don't know, phenomenon. Let's put it that way. That seems to be taking place, and it goes against the analysis and commentary I keep reading on X and in other places about, gold had gone parabolic and was overbought, and that it's a crowded trade, and that, kind of making it seem like, like suddenly everybody owned gold, which we know isn't true. And still, what, 98% of financial advisors or something admit their clients don't have anything in the precious metals. So, I mean, maybe it's okay, it can get overbought from a technical perspective, but that's how, bull markets operate. It can get crowded. It may seem crowded because some of us that focus on this, we think everybody else in our little sector is focusing on it, but it doesn't seem like anybody else is. And at the end of the day, what has always been the driving force of price is the futures market. My old friend Ned Naylor Leyland famously coined the phrase 15 years ago about the futures tail wagging the spot dog. And so when you watch the positioning as reported every week in these commitment of traders reports, generally speaking, when price is going up, the hedge funds, the speculators, the average trader, whatever, are getting long. It's like anything else. When the Mag 7s are going up, people are buying the stock and they're getting excited and they're looking to make money on the upside. And that's generally how it works in the futures market. You get a big up move, the speculators are buying, and then the commercials, be it the producers or the banks, the swap dealers, whatever, they're usually shorting. And got opposite sides of the trade. But on a big week when price is going up or in a trend where price is going up, generally that's how it works. The positioning gets really heavy on the long side for the speculators and gets heavy on the short side for the commercials. And then, you run out of momentum. Everybody's going to buy is bought. Price begins to tip over, maybe takes out a trend line, a moving average. The selling accelerates. The speculators begin to dump into that weakness. The banks and the commercials buy back and cover their shorts. A new equilibrium is reached, and then it all starts over again. In a bull market, it's a higher high next with a higher low, and then another higher high as everybody rushes in again. All right. With all that as a background, we're seeing the exact opposite happen now in gold. There was a survey last Tuesday, the 22nd, that came at the end of what had been a very big 4-day rally in gold. Now, I say 4 days because Friday, the whatever that was, the 17th or whatever it was Good Friday and everything was closed. But over the 4-day period that this survey covered, gold was up $179 and open interest was up too. So anybody that's ever tracked the commitment traders report, myself included, thought, okay, whole bunch of speculator buying, whole bunch of commercial shorting, because that's how it always works. And in fact, it was the exact opposite. And it's the opposite that's continuing a trend that goes all the way back to February. And so what we're left with is a picture that's totally different from what you'd expect. Price has been rallying not because of speculator buying and short covering, but instead it's the banks and the commercials and the producer hedgers that are buying and covering shorts, while the speculators are doing the opposite. It's a very strange and conflicting signal. And when I decide exactly what to make of it, I'll let you know. It's just so unusual. It's hard to make any, big statements about what's really driving it.
Yeah, Craig, it is bizarre because you would think that the commercials would have shorted the higher prices. Usually banks are doing that to, to cover their longs, but then also get in position for the eventual price dump. But if it's the speculative money that has been dumping the higher prices, is it possible that banks and financial institutions are actually better gold traders than traditional retail or hedge funds just because they're more patient? All the buying has been central bank buying for the most part, not all, but a large percentage. Is it possible that in this gold cycle the banks are the better traders?
I don't think that's so much, Shad, as I'm wondering, you know, and again, there's so many moving parts here. You can't really ascribe it to one thing. But I read things about, this Basel III deal, and whether pricing power is shifting east, and all these different things. And it just makes you wonder if somehow the game is changing. Because again, for as long as I've been doing this, 15 years now, in a rising price, the commercials, whether in gold or silver, they add shorts. They're taking the opposite side of the trade, creating new open interest to sell to all these hungry speculators who are trying to get long. And that, again, that demand, that buying demand pushes price, incrementally higher. This is the opposite. Again, this is commercials who are adding longs and covering shorts. And so that's what I'm getting at. I mean, is there a bigger picture here of a something else within the game, if you'll call it that, that has changed? And that's what we've got to try to assess. But all I can tell you guys is if you go back to the most recent peak in this positioning, you go back to the Commitment of Traders report that was surveyed on February the 4th. Okay, so we're talking 10, 11 weeks ago. Price on that day, Tuesday, February the 4th, was 29.01. In the time since then, the large speculators, if you just look at their gross long position as a group, they've dumped 100,000 longs from 356,000 to 259,000, while the commercials have covered more than 100,000 shorts. And price has gone from, again, 29.01 to, I think last week on the survey was 34.10. That's a $500 rally while the speculators are selling and the banks, by any definition, when you're short covering, are buying. Really odd time.
Greg, what's been happening with overall open interest then? What's been the trend here? Usually when you see open interest increasing with some of these trends that we're seeing within the speculators and the commercials, that signifies a stronger trend in those trades. So what are we seeing in terms of overall open interest?
That's contracting too, Corey. On that same report from dated the survey February the 4th, total open interest that day was 542,000 contracts. Total open interest last Tuesday, the 22nd, 465,000 contracts. It's fallen even more. Heck, as of Friday, 3 days after this most recent survey, we're down to 445. I mean, there were times 5 years ago, back before COVID, I think we had the all-time high of about 800,000 contracts of open interest. So again, if anything, this notion that gold is somehow overbought. We've seen some, historic once in a generation blow off top where everybody's in the trade that's going to buy is bought. That's just betrayed by this data. And I mean, I'll put it another way. These positions, when I mentioned the large speculators as a group, hedge funds and whoever else fits in that category, again, as of last Tuesday, the gross amount of contracts, not the net where you subtract the short from the long, the gross amount of longs, 259,000 contracts or so. That's the smallest gross long position since the survey of February 27th, 24. Now, what's significant about that? Well, if you remember back, it was on March the 1st of last year when price finally broke out above 2,100 and then soared over the next 6 weeks to about 24, 2,500, as everybody piled in and saw the breakout. Well, anyway, what I'm getting at is we now have the same total, basically, of large spec longs as we had when price was 60% lower. Something unusual is happening here. And we may not really be able to see it in real time, but this is really some strange stuff.
Yeah, Craig, and I guess let me just reframe what I'd asked last time. What I was saying with the commercials is, do they sense the banking institutions? Because again, we've seen all the central bank buying, we've seen banks here with reducing their shorts, increasing their longs, at a time where a lot of people think, wow, I just don't believe this higher gold price, including some of the mining stocks don't believe it. And a lot of the retail herd and even the hedge funds, they're in this thing for a trade. So they see it being overbought on the charts, they get out of gold and they're dumping their longs. Is it possible that the banks sense that this is a longer term trend? And to your point about what it looked like last year, that was right before a breakout where a lot of people are top calling and saying, hey, that was it, 3,500 on the futures, that was it. Could it be that the banks realize that this is a longer term trend playing out than even most people are realizing, and that we're nowhere close to the top? I guess that's what I was trying to get at, is could they be seeing something like you're saying the game could be changing? Is there something where gold goes much higher from here, and at a time where most of the speculative punters are doubting it?
Yeah. No, I see what you're saying, Shad. And yeah, they're just like, you know what, the heck with this. We got to either cover some of these shorts where we're just getting our asses kicked, right? I mean, in this report last week, in that commercial sector, they added 20,560 new longs and covered 9,084 shorts. So it's one, we got to, someone's out there going, yeah, we got to, I mean, we're just getting crushed here in this short. So that's a short squeeze where you just, you finally can't take anymore and you got to cover those shorts. But it's not just that. I mean, if it was just all short covering, okay, that'd be one thing. But it's the 20,000 new longs that's like kind of goes to your point. They were there, maybe they're just like, hey, we got to get on the right side of this trade. So then it makes you wonder, okay, what if we go back from here to a kind of traditional sense where these hedge funds start buying again? Like I said, their gross position is 100,000 contracts less than it was 2 months ago. Well, what if that 100,000 contracts of buying power, buying whatever, comes back in? Well, who's taking the other side of that trade if the commercials aren't? So anyway, I say all this because I read this stuff. I mean, this is all I do all day long. I'm looking for stuff to comment on in my daily podcast and everything else. So I'm scouring Twitter, I'm scouring on this weather, and I kept seeing the same message over and over last week. Oh, it's overbought. Oh yeah, this is a chance you got to get out because it's a crowded trade. It's a contrarian signal. You better get out. Well, maybe not. Maybe this is telling you a different story, and that's all I want people to consider.
So, Craig, how should we balance this out with the money that we've seen flow into gold ETFs? First quarter of 2025, the largest quarterly inflow we've seen in 3 years, over $21 billion of net inflows. And something like the GLD, its assets under management are over $100 billion for the first time ever. So, how do we balance out what we're seeing in the COT reports and what we're seeing in terms of money flows into these gold ETFs?
Well, there's 2 points there. One, how much does that actually impact price? And I don't think anybody really knows the answer. Money flowing into the GLD or some other ETF, do they really immediately go right out and secure gold with clear title and they got to go buy it on the open market to put it in the vaults in London? I mean, so how much is there a direct dollar for dollar impact or is it a dollar, a penny impact? I don't know. I mean, that's the first thing we got to think about when you talk about the ETF buying. But then again, Corey, hit me with those dollar amounts again, $100 billion or whatever it was.
So just in the GLD, assets under management as of April 21st was over $100 billion for the first time. And just in the first quarter of 2025, $21 billion went into gold-backed ETFs.
Okay, let's stop right there. $100 billion. And what's the market cap of just NVIDIA?
Oh, hey, no, I get it.
You know what I mean?
We can talk all we want about how small the gold sector is, but the fact of the matter is it is growing right now in terms of ETF valuation.
Right. But my point is that's just not very much money in the grand scheme of things.
Yeah, but are we ever going to be the tech sector here, Craig? This is a whole different conversation. Is the gold sector going to be the tech sector? I don't think so.
We've been talking about this for a decade, brother.
Exactly.
One of these days, maybe. But
I doubt it. Come on, Craig.
come on. I see that as a drop in the bucket. I know it's like the old story. One of these days we're gonna be talking about real money, a lot of money, billions and billions. But when, I just thinking of how I watched CNBC 2 weeks ago and the Dow's down, 1,500 points. And they're like, oh my God, the total market cap is, that's $2 trillion of market cap lost. And we're talking about the impact of 20 billion. That's all. I mean, I don't know.
It's
I
showing
would,
a trend though, Craig. Like there is
well,
interest in here and it is growing, which is nice to see. Hey, look, we saw
absolutely.
the gold sector contracting for a long period of time. That switch has flipped here. There is money
Beautiful.
coming in.
Right. But that alone is not a reason to then say, oh, I better get ahead of this and be a contrarian and get out.
No, that's fair. I'm
I've
not saying
15.
that. I'm just saying we do need to accept that money is coming in here. And I was more asking how you balance that out with the COT reports then.
Yeah, no, again, we all want money in our sector. I'm just saying it, and I'm not saying that this is what you're saying, Corey. That's what I get in the sense of perusing the internet is this idea being put forth that because $20 billion, flowed into the ETFs, that must be a sign now that everybody's long, everybody owns gold and buy. That's a sign of a top. I've just for 15 years trying to get people to prepare for the end of this debt-based monetary system by owning gold. And I still got people on my side that are like, you know what, I'd have given up in 2015 if you weren't so damn ardent that the math was the math. And now I've hung in there and gold's three times higher. And I'm glad I got it. And I just would hate to have anybody, with the end kind of staring us in the face at some point here, to have anybody say, you know what, I was gonna buy some gold, but I'm not gonna now because I read on Twitter that it's a crowded trade. Let's try to keep some perspective here. That's really all I'm saying.
I think it's a good point, Craig, because people don't say that, the dollar is a crowded trade or the yen's a crowded trade because they're currencies, and really gold is an uncurrency. It's a currency that has no fiat connection to any country. So even if a lot more people piled into gold, it's not really a trade, it's an insurance policy. So it's kind of crazy to think of it as a crowded trade or even as a momentum trade because it's not. It's a currency of last resort, and it's something to counterbalance all the risk in the fiat system. But I do want to get your thoughts on silver because, Craig, I've had several people email me in the last week or two saying, when will silver start breaking higher and catch up with gold? And I don't know if you see anything in the COT reports or anything in the data you're looking at that shows more interest. Obviously, it's not a true precious metal. It's not being bought by central banks, but people still look at poor man's gold to eventually catch up. How are you looking at silver?
It's just got nothing going for it at this point, and it's maddening for everybody. Everybody sees that gold silver ratio or whatever, or even on a day like today, gold's up however much it is from Friday, $50, and silver's unchanged. The traditional form of commitment of trade report is still in effect in silver. Last week, silver up 60 cents again, while gold's up $180. Open interest was up, and the large specs increased, let's put it that way, their net long by about 1,000 contracts, and the commercials increased their net short by 1,600. And that's kind of how it always works. That's what makes the gold thing even more peculiar as we look at it. Silver just doesn't have any positive momentum. It's kind of like, how did silver get going to the upside? Well, it got going to the upside. It has to actually get moving for people to pile in. And when it actually happens and breaks out above 35 and gets rolling, why did it then go to 45? Well, because it got above 35. You know what I mean? It's such a small market that unless it has momentum and movement, it's just overlooked and ignored. And that's kind of how it feels now. And the other thing too, Shad, as we've discussed for years, the curious thing about our computer-driven markets is that the GDX and as a proxy for the shares seems linked long-term at least to silver prices more than gold. Now this year it's performed kind of better than silver and closer to gold since the first of the year, but nonetheless, history has shown that we need silver to go up to get the shares to go up for whatever reason. And so, yeah, we all have an interest in getting silver to move. At some point it will, and it will create its own momentum. It's just that it hasn't yet. It does not have as bullish, if you will, commemorative trader structure that gold currently has. But it's not terrible either. It's just, well, like I said, it's like a perpetual motion machine. Something's got to get it shoved, got to get the motion started in the first place, and we just can't seem to get that to happen.
Yeah, silver very much is range bound right now.
Yeah.
But let's take a look at the longer term chart because, look, let's go back to 2012, 2013. Silver was moving down. Once silver gave up that $20 level back in 2013, it took until 2020, 7 years to get back above $20. And then it really did, in a way, try to stabilize above $20. Yeah, we had a little drop in 2022, but broadly, silver was between about $30 and $20. And then we finally had that breakout above $30 after about 3, 4 years of consolidating there. And now we're back holding above $30. This has been for about a year, a little
Yeah.
over a year now. So this is a higher pricing environment. What do you take away from, again, kind of these trading ranges that silver does get stuck into for years on end, but at least now we're in a higher trading range?
Yeah. No, and it's all a matter of perspective, It's like I see people talk about, oh, the mining shares never do anything. They don't go up. Well, if Agnico Eagle is more than double, like up 250% in the last year, if you just own that one and that's your time frame that you want to cherry pick, you're doing great. And the same thing could be said for silver. If you've just only been buying silver since 2017, hey, that thing's doing great. It's just that so many of us still own silver from 2011 and 2012, and so you feel like 14 years of basically going sideways. So it's a function of that perspective as well. But you're right. I mean, it is slowly ratcheting up. It's like taking the stairs higher on like a monthly chart. Again, though, the history that we have with that metal, we all want it to take the elevator up instead. And it just seems like that's the last thing it wants to do. And it makes everybody pull their hair out.
Well, I think the other thing with silver is just that a lot of people see gold making new all-time highs. Really, the all-time highs were made at the end of 2023. If you remember, we had those all-time daily, weekly, and quarterly closes at the end of 2023, which set up the big, huge move. After 2 months of consolidation, January and February of last year, then March was the big breakout. But really, things started at the end of 2023. I could understand silver not getting the memo there because it was still a tug of war with gold. But when gold finally broke out last year, a lot of people expected 35, 40, 45, and then that $50 target, the big $49, $50 range for silver to be in the sights, and it hasn't even gotten close yet. And when you look at the gold silver ratio, as you mentioned, I don't put a ton of, stock in that, but I do notice when it's at extremes, and when it's at 100, that's an extreme. So just from a catch-up standpoint, people are expecting that. Is it possible it doesn't catch up this time? That for some reason all of history doesn't repeat itself and silver does not catch up to gold. Is there something that could have changed?
Oh, I'd like to think not, Shad, but and rather than, speak for everybody else, I'll just add, the last couple of annual forecasts I've had, my goals are pretty, calm compared to other things that I see. I think even this year I said, man, we'll get up into 41 or 42 during the year and probably settle back to 37 or 38 by the end of the year. So that's a solid year, but I've yet to print a forecast where I'm like, yeah, this is a year we're gonna go to 48 and 52 and all that kind of stuff. So anyway, I don't think that means that it's never gonna happen. And like I said, the thing could really um take on its own life, and people's always, wow, look at silver's moving. Oh, okay, it's finally that gold silver ratios that, and people start paying attention to this stuff, and all of a sudden it could be $50 this year. Not saying it can't. Um, but for now, I'm just kind of for my own personal forecast, I'm going to continue to stick with this. We'll see if maybe we can't by later this summer get above 35, bump up to 38 or 9, that kind of thing, and just continue that stair step higher that Corey mentioned earlier.
Well, Craig, if we do see silver spike higher, that unfortunately can be a negative, I think, because it usually
Yeah.
does signify a top in the market. So this grinding couple year consolidation, then move higher can be, I think, more positive. But hey, overall, I still see a lot of positives for the precious metals. Try not to pay too much attention to everyone trying to say that it's too overcrowded, Craig, because that is actually a bull market. There's nothing wrong with a crowded trade there, but it's that we're just not used to it in the gold sector. I think still a lot going in the favor of gold and even the precious metal stocks. A lot of them continue to do quite well as well. Again, Craig Hemke, founder and editor of TF Metals Report. Click that link in the show notes to follow along with what Craig is writing. Craig, as always, thanks for your time today.
Love it, boys. Have a great week.